Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Lots for us to talk about this week with the Fed 50 basis point rate cut. We did cover a lot on that throughout the tail end of the week, and some of the market moves, a lot of different markets moving and continuing to all-time highs. We'll try to filter through what the noise is and what is a sustainable rally for you all, especially in the first couple segments where we chat with Rick Bensignor, and then in the back two segments we are going to shift our focus over to the energy sector, which in itself is interesting, with oils break down to $65 and now very quick rebound back over $70 a barrel. As I mentioned, we are kicking off the show with Rick Bensignor, president of Bensignor Investment Strategies. He writes the institutional newsletter called Supposedly Irrelevant Factors. That is read by some of the most successful hedge funds in the world. On the retail and individual side, check out In the No Trader website. I'll put a link to that in the show notes. Rick has 3 products within that: a monthly report called 7-Eleven, where he picks no more than 7 of the 11 Spider ETFs with the goal to beat the S&P, a weekly report called the Tactical Trader Report, and a daily report called the Daily Tip Sheet. Rick, let's start off with the big news from this week that did move markets, kind of expectedly so. That was the Fed rate cut. It seemed like it was a coin flip between 25 basis points and 50 basis points. The Fed went with the bigger rate cut there, 50 basis points, and is now still projecting 2 more, at least 25 basis point cuts through the rest of this year, and even more cuts next year. Rick, what was your takeaway from that Fed statement, the rate cut, and Jerome Powell's press conference this week?
Look, I think Chair Powell finally did what he should have done months ago, but at the same time, I give him credit, which many people don't do. It's a very difficult fine line to walk in order to keep an economy growing but not have inflation get out of control, which it had. And he's trying to balance these out so not to bring inflation back up, keep the economy growing. And it's not an easy thing. And I think generally he's done a pretty good job. He could have done the cut, I think, back in July. But in general, whether it was 25 or 50 bips, I don't think was the huge thing. He needed to do something, and they finally have. And if you look at, Fed fund futures going out into next year, and even by, let's say, December of next year, you've got the street pretty much looking at the target rate for Fed fund futures, or, well, better said, for Fed funds is going to be, in the 2.75 to 3% level. So that's well down from where we are now. So the street is looking for cuts to continually happen over time. And the question is, how much of the cuts, at what point does that bring inflation back into the picture? How much, if we get down to 3%, then you've likely increased the odds that inflation returns. And that's not what Chair Powell wants to be seeing with his target rate around 2% or so, and that's their stated mandate. So it's a difficult thing to do. The street generally thinks rates will be coming down over time. The U.S. 10-year probably ultimately gets to 3 to 3.25 or so, but it still has yet to even hit the measured target off of the 5% secular high, which is 3.53. I think the low of the move is 3.60. So, it's only 7 bips. We got close. But in general, you probably want to be looking for rallies in the rate market, or another way of saying that is declines in bond prices, to find places to buy bonds for that move down towards 3.25, 3%. But then I think you probably get into another secular bigger move higher over time that puts yields back to potentially the 5%, even 6% over time. And if you look historically, that's more of an equilibrium price than where we are now. So we're still in a low interest rate environment. Of course, if you're a 30-year-old kid, you don't think it's low when you try to get a mortgage, and recently you had to pay 7%. For me, I grew up a kid in the 60s, you get a 7% mortgage. Yeah, that was very normal. That's long-term equilibrium area for mortgage rates. It's just that people are so used to what has been a low interest rate environment for years that, home ownership and the younger generation trying to buy a home and seeing what they have to pay for mortgages, considering 3 years ago you could have gotten a mortgage for, 2.5%, 3%. It's shocking to them. But in the world of economics and just cycles, seeing a 7% mortgage is not, it's not out of the norm at all when you look at the long-term picture of where interest rates are. So I think generally Fed's done a fairly good job. Again, they could have gone a little earlier with the cut, but I'm glad to see Chair Powell has, look, he indicated at Jackson Hole that was likely going, the cut was coming. They did do it. There's more likely coming down the pike, and it's good for the consumer, generally good for stocks. But so much of the post October 23 rally in the S&P was all based upon the Fed cutting rates. Remember, in January this year, there were 7 cuts priced in by Fed fund futures traders. Now, we're through the September meeting and they finally cut. So they've been pretty horrific at betting correctly on what the Fed would do. In general, I'd say, that helps keep things positive for the market, but I also think that we're getting closer and closer to major upside targets in the S&P that you could easily see a double-digit fall once we get towards, let's say, 6120, which is a long-term projected target, as well as a medium-term one measured off of a completely different level. They both come into in and around that 610 level for spiders, which is about 6120 or so for the actual cash S&P. So yes, there's some room with the S&P trading now at about 5,700. Still have 400 points to go. But in the grand scheme of things, I'm not sure we get much above that.
Well, Rick, to that exact point, that's kind of what I wanted to ask you about. If the markets were very excited about this rate cutting cycle a year ago, more than a year ago, really at the end of 2022 coming into 2023, and then all the way through 2023 coming into this year, we've been waiting for these cuts for 2 years. And now that they're here and there's going to be a series of cuts, just a couple points. Usually a rate cutting cycle is not positive for the markets. It may run for a little while, but it tends to show that a market tops. I just saw a chart out this morning that somebody posted, and it was from the Rosenberg Research and Haver Analytics, showing that every time there's been a recession, it followed a peak in the Fed's funds rate, which we just saw. And then the third thing would be the yield curve uninverting. The 10 and the 2 have come down a lot, but now the yield curve is steepened. And it's when the yield curve uninverts that you see weakness. With all those things stacking up to the point you just made, could we see the market maybe rally for a little bit, but then could that be the blow off top where we see a double-digit correction?
I very much believe so. Yes, I think that's what's likely happening. The cuts will bring some more money into the market. The people who've been on the sidelines will come in, and it would not surprise me whatsoever if the investing public ends up buying the last 5% of the rally before things fall.
Rick, I want to ask you about that whole concept of, yes, rates historically are low, but we can also balance that out with debt levels being much higher and the cost of money, or money not being able to get you as much. So I understand back when you were much younger, rates were higher, but house prices were much lower. Now, if you tacked a 10% rate on where the median house price is now, which is multiples higher than when it was 10, 20, 30, 40 years ago, it's completely unsustainable. So do we need to adjust what we consider as a historical average for rates because of the fact that money just doesn't get you as much anymore and debt levels are that much higher?
Sure. I mean, you can, instead of looking at rates in a pure vacuum of themselves, you could look at rates, let's say, divided by CPI or some inflation factor that more accurately over time gives you a sense of a proportionality between where they are now and where they had been in the past. So, I mean, it's certainly a fair statement to say that the value now of a dollar is way less than it was 30, 40 years ago. And that's, the inflation factor. It's the same thing. When I think about when I was a kid, what a new car would cost, was, I don't know, $5,000 to $6,000. Now you're talking about the average car in America, I think, is about $45,000.
Yeah, we're
Huge
10x
difference
on this kind of stuff. Same with home
Yeah,
prices.
yeah. Um, Here, I'll give you an example. My parents bought their home. The house I grew up in was a new construction. They bought it in 1958 in a kind of upscale neighborhood on Long Island. And the cost of the house, brand new from the builder, was $18,500. The same thing now, if a builder were to go into that neighborhood and build a brand new home, I don't see how it's less than $1.5 million,
Yeah, it's crazy.
right? I mean, that's not 10x, that's almost 100x.
Well, Rick, you brought up the dollar. A lot of people have been focused on how this rate cutting cycle could affect the US dollar. So I'd like to get your outlook on it, but also weave in the yen currency. It has possibly appreciated a little bit over the last, let's say, month or so. But if the dollar starts to weaken, could that exacerbate the yen carry trade again? Because that's where some of that selling pressure came on. So your outlook on the dollar, and could it affect the yen currency as well?
Well, look, there's a few things. Let's address the dollar first. Dollar's been in a trading range for a couple of years now, roughly, I don't know, let's call it 106. I'm talking the US dollar index, 106 on the upside, about 100-ish, 99, 100-ish on the bottom side. You're just shy of 101 now, so you're on the low end of the range, but you're getting into an easing cycle with rates coming down. And in general, this is not a correlation of 1-to-1, but if rates come down, the US dollar's value will likely come lower too. Now, there are political events and other things they keep always, a dollar bid to it relative to other currencies, but you could still see if the US 10-year gets to 3%, the US dollar is not going to be trading where it is now. It's going to be lower. And the lower dollar is going to make for a higher yen, a higher euro, and other currencies against the dollar. And the carry trade issue that happened on August 5th that spiked the US markets down and yen up, I've actually been bullish the yen since, because I think it was a change in the market. Now, there's a lot of talk on the street that hedge funds are starting to use the dollar as the source instead of using yen and selling yen in order to then take that money and invest elsewhere. There's a lot of talk that hedge funds are switching to shorting the dollar, that the dollar ends up becoming now the currency that is used versus other ones to raise money to invest in non-dollar denominated assets. And that in and of itself could certainly lead to a whole nother leg down in the dollar. And, let's put it this way, if the dollar materially breaks, well, let's just say 99, I got to always give a little leeway from the prior lows. So the lowest low in the US dollar was back in summer of last year when the US dollar index got to right around 99.5. So let's say you break 99 and you stay beneath 99. You're talking about a target at 92 next. That's pretty significant in dollar terms. And if that's the case, that this all kind of works out that way, then yeah, you're going to want to be long the other currencies. And that's, of course, a boost for the metals. Anything that is priced in dollars ends up costing less, which makes crude oil, which is still globally priced in dollars, relatively cheaper. So I don't think there's anything to do in the dollar right now other than to watch. And you're at the low end of the range, sure, you could nibble on it and try to play for trading bounces. But if you're looking big time macro, if you break 99 and it's not a quick event that comes right back, then you're talking about a substantially weaker dollar coming. And anything that relates to that, you need to be prepared for in your portfolios, because that is a potential significant shift in lots of different ways. It also means that potentially non-US equity markets do better than the U.S. market? I mean, there's a lot of implications if the dollar really breaks beneath the lows of the range. And again, you have to sometimes take your trading hat off and look at the bigger picture. So again, one day, one weekly close underneath the the summer 2023 low doesn't mean, oh, the dollar's gone. But if it breaks again in the neighborhoods of 99 and rallies start failing, then you got a whole nother big move coming down in the dollar, and all the implications for that you need to put into how you think about markets going forward.
Yeah, big change for the markets then with how strong the dollar has been. Let's move to the metals and commodities then. As you said, a weaker dollar can help commodities, but broadly, we've seen a nice bounce in commodities. We still have gold very much leading the way over 2,600. Copper managed to bounce at around that $4 level up to 430 now. Oil did break down, but as I said, is back to $71. Is it commodities in general here, Rick? Could they, if that dollar breaks down, be in for a longer, more sustainable bull market that pushes most commodities to maybe some all-time highs?
Well, look, it certainly can. Let's talk about oil at first because it's the most globally used commodity and it's the most universally priced in US dollars. That, in gold, but gold is a tiny market compared to what oil is. So you mentioned that oil had gone down to 65 and bounced. It's bounced mostly, in my view, for two reasons. Number one is 2 weeks ago, the Commitment of Traders report showed that hedge funds were more short oil than any time in the history that oil has traded. So any little bit of news that is potentially bullish news can squeeze a lot of people very quickly. So, the Mideast tensions getting higher and there's, Hezbollah sending endless rockets into Israel and then Israel this week pulling off, I don't know, I'll call it Beepergate or I don't know what you want to call it. What's going on is just heightening tensions. Iran threatening more and more, saying we're getting, can get involved and are planning to get involved. That's where the bid comes from oil. There seemingly is, from the fundamental point of view, there's lots of oil out there. The U.S. output of oil is immense. We can, provide oil for not only America, but for lots of the world. That's how much supply is being generated by the U.S. And we're no longer OPEC dependent the same way. And, oil could very well be capped in the, mid 80s or something like that, just on any type skirmish type rally because of supply issues. So if you see something happen that spikes oil up and open interest unwinds such that shorts end up getting squeezed out and they're paying for lower price shorts to people who are long and getting out. So if open interest falls on a spike up in oil, you know that those who are long are selling out to those who are being forced to pay up because they're trying to avoid larger losses. That's a clue that you really don't have enough demand for oil to keep prices up. It's a trading type of move. It's not a whole change in fundamentals. If the dollar goes down, it universally helps the price of oil. That's a good thing. But whether or not this translates into a whole run up in commodities is a different story. Gold is getting close to, we've talked about this a month ago. I mean, I've got targets within where gold is now. You're less than $100 from major targets. I think gold is close to getting a peak. And others will argue gold's going to $3,000. I personally don't think it is, not in this piece of the cycle, not without seeing a few $100 pullback. Gold could easily get down towards $2,400 again, $2,450, where it broke out from several months ago. So you could easily, you could get a 10% pullback in gold. And I'm not sure you really have much more than 10% upside from here. So I would not be buying personally, even on a day like now where gold's up big today and is making, again, new all-time highs. Would I be buying gold up here? I'm not. I think people who are buying gold here are most likely forced to buy gold because they're short from lower levels. And then you have the gold bugs who they're bullish anytime. And if you're a member of the public who does not follow the price of gold and you see some TV ad that says, buy gold, it's up such and such percent in the last 10 years or last 20 years. Yeah, gold has been actually a phenomenal investment. And I've been long gold for, 10 or 15 years in my own accounts. And I was a commodities trader. I was a pit trader. I traded COMEX gold of one of the many things that I traded on the floor of the exchange. So I've been intimately involved in that market for years and years. From an investment point of view, I've been long 10, 15 years worth in gold, and it's paid off really well. It's done probably in the last 20 years, give or take, you're probably close to what the S&P has returned. I mean, it's been a heck of a good longer-term investment. But I do think we're getting closer to a place that you really have to question how much more gold has to the upside. And if the dollar falls, it'll certainly help. And then if I sell out of some up, somewhere around here, I'll probably end up being wrong. But if the dollar doesn't materially break, then, gold is due for a few $100 pullback and something to consider reducing rather than just, you have to think about too, when you're an investor or a trader, who's telling you to do what and when they tell you to do it is always important. And most people don't think in those terms. But when you start hearing people hawking gold, it's funny. They don't hawk it when it's $1,000 an ounce. They hawk it when it's $2,000 an ounce and $2,500 an ounce. Always easy to hawk something when it's in a trend and seems like the right thing. But just like perma bulls, there are people on TV all the time who, no matter what happens in the market, are going to tell you to be a buyer. And, in this day and age, we kind of know who that one person is who is forever on TV and only talks about the stock market in one way. And yes, this person's been right to be bullish. But if you're a strategist and you're not mostly bullish the stock market over time, you're a fool. Look at a 100-year chart of the Dow or the S&P and tell me which way should you be, bullish or bearish. If you're a public-facing strategist, you should be bullish most of the time. So that to me is useless information to be bullish the stock market. Everybody knows to be bullish the stock market. The value of a good strategist is to tell you when to be bearish and to be right about that. And the perma bulls don't, to me, provide any value because they're telling you what everybody in the public already knows, which is over time, you want to be long equities.
Well, Rick, just following up on kind of weaving a couple of these ideas together with the dollar, with gold, with inflation, what does it say? Because so many people look at the dollar index, but that's really weighted against maybe 6 other global currencies, and you're looking at the dollar
mostly
rising.
The euro.
Mostly the euro. Yeah, a little bit of yen, a little bit of the pound. But when you look at gold, when it was unpegged in 1971, it was $35 greenbacks. 35.
1974.
Yeah, and so 35 greenbacks to get 1 ounce of gold. Gold hasn't changed. It's on the elemental table. It's just a rock. But now it takes 2,648 greenbacks to buy one. So when people look at that, what does that say about the loss of purchasing power in the dollar and the effects of inflation on, even the house example you mentioned? How does inflation tie into your investing thesis when, some of these things are assets that can levitate you out of the dangers of inflation?
Yeah, that's why everybody should own some gold in their portfolio. And generally, I have said traditionally, 3%, maybe 5%, but not more than 5%, because traditionally, anything more than that was you were truly betting on the price of gold to do better than the stock market did. And honestly, in the last 20 years, I'm pretty sure it's been pretty equal to the S&P. So it's been an extraordinary period of time to be long gold. But if you look at the 20 years before that, you did not do well being long gold versus the market. And so, yeah, you should have some gold as a hedge against inflation, and it has acted nicely as one. So it has served its role. But if you look at the S&P, they're fairly comparable. If you look at any Mag 7 name versus gold, I'd say you did better in Mag 7, and remarkably so. So, it belongs in your portfolio. It's a matter of how much and at what price you get in relative to where it is in its trend. as you say, you're paying the most now than, you buy gold today, it's the most expensive it has ever been in the history of purchasing gold. So
even when you compare it to inflation adjusted too.
Correct.
So, Rick, what does this mean for the gold equities? Do you see opportunity because the gold equities have lagged this move in gold so much? Just look at a chart of GDX, a longer-term chart of GDX compared to gold. It's vastly different, not even close to its all-time highs. Gold keeps hitting all-time highs. Do you see the opportunity of investors to leverage this move in gold for a catch-up trade within the gold stocks?
In theory, it should. And if you had asked me any time prior to where we are now, I would say yes. As much as you want to own GLD, you want to own GDX also because it is so miserably underperformed gold. So if you think about a rubber band that's been stretched, the disparity between the price of gold and GDX is so large, you would think gold miners should catch up to some degree. But if we look at GDX, which is trading at $40 and change, the all-time high in GDX was back in 2011. And there it got to, I don't know, $67, right? It's trading 40 now. So you got this thing needs to increase 50% to get to all-time highs at the same time that gold is on all-time highs. So it's either telling you that gold miners are a horrific investment over time, and that you're much better off in gold, or you're finally going to correct and GDX, ends up making a substantial up move. Now, since this thing peaked in 2011, when it went from, what did I say, $16, $67, it got down to 12 and a half, right? So it lost, what is that, 80%, something like that. I'm not sure, my math in my head quickly, but something in that neighborhood. I mean, it lost something like 80%. If you look at the charts, it's been trying to make a bottom now for years. And if it breaks out above the 2020 high, which was about $46, it could then run to 51-ish, 52 or so, the 2012 high, but then it has plenty of room to go, technically, up to anything remotely close to what the all-time highs are. So I've got about a 50-50, personally, I have about a 50-50 split between gold and GDX. And clearly the gold was the much better investment over time. I'm willing to hold GDX for the hope that, 5 years from now, I'm right for having held it and that it plays some significant catch up. The one thing that I worry about a bit is that because I only think the S&P has a few percent more to go before topping and then selling off double digits percentage-wise, GDX is gold stocks. So they're stocks first and gold stocks second. If the market comes off, GDX may very well come off too. So if you can't get the breakout above 2020's high at, I don't know, 46-ish in GDX, and the S&P peaks and starts falling, then I think this GDX breakout to the upside just gets delayed and it's more kind of pain. You've got a fairly flat 200-week moving average at a little beneath 32 now. So if we're at 40, that's 20% down to get to kind of, the average price over the last several years. It's a tough thing. Gold miners, just haven't performed, and the juniors have been a disaster. So I think you hold on to GDX and then you hope that the situation, something comes about that ultimately changes what's happened for the last 10 years and finally gives, gold miners some type of boost to the upside. So I'm going to probably hold on to my GDX, but I'll probably reduce some of the outright gold ownership.
Rick, I'd also like to get your thoughts on copper. We get a lot of thoughts on the good doctor, and I wonder if the dollar falling could be more of a driver for it, or if the potential recession and contraction that so many are still looking for, not just in the US, but in China and Europe, how does that weigh on copper?
So look, copper's bounced the last couple of weeks, but it's nothing special. 2 weeks ago, 3 weeks ago, it was on its slightly upward slope 200-week moving average. A bottom between $3.90 and $4. We're talking U.S. COMEX copper. And now it's trading at, I don't know, what, 435-ish, something in that neighborhood. Without China, I don't see copper getting a major move higher. So it's, right now it's bottom where it needed to, which is in the last 2 months, multiple weekly lows traded down to even sometimes through the 200-week moving average, but it basically bounced from there, as well as a major uptrend line, also going back much farther in time. So if you go back to the July, 2022 low, the lowest low in copper, in the whole cycle, the recent low about 6 weeks ago was somewhat near there. And let me see, and also near the trend line from last October's low. So technically, it's bouncing on some support. China is kind of a dead issue right now. Second largest economy in the world, but a crappy, phase it's in now. Their stock market's horrific. It's not investable, and China's not, materially buying copper right now. So I've got no particular opinion on copper. Where we're trading now is also where the January 2023 high was. So this is kind of an inflection point also. There's other markets to trade. Unless you're in the copper industry, whether as a buyer or a seller, there's no reason for the average investor to be looking at copper.
All right, Rick, we'll wrap it up here. Thank you so much for your time and breaking down a bit more of a focus on your trading strategies around commodities. Again, Rick Bensignor, president of Bensignor Investment Strategies. Click that link in the show notes to visit the In the Know Trader website. Read over the different products that Rick has for all of you individual traders managing your own portfolios. It's always insightful hearing how you're viewing these markets, Rick, and I look forward to following up with you later next month. Everyone, stick around. We're going to be right back.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
Welcome back. Continuing to listen to the weekend edition of the KE Report. Boy, oh boy, a lot to cover with the market moves this week on the back of the Fed meeting. As I mentioned, we covered a lot of those moves through daily editorials nearing the tail end of the week. So please, everyone, go back through our website and podcast and YouTube channel to listen to and catch up on a lot of those interviews. Now it's time to switch our focus to the energy sectors. We are chatting with Josef Schachter, founder and editor of the Schachter Energy Report, also the free report, Eye on Energy. One thing to note, too, is Josef's conference is coming up very soon, October 19th. This conference is in Calgary. I've been a number of years, and it's well worth your time if you want to get in front of a lot of CEOs to learn more about those companies. Josef is also offering 2 free tickets to this conference, something that we'll talk about in the later part of this segment. Josef, let's start off with the moves in the oil price. The recent drop down to $65 a barrel in crude. This was a level that you were outlining to us even a couple months earlier, saying that when oil dropped, you would be issuing a lot of buy recommendations for individual stocks to your subscribers. I saw a couple of those recommendations come through. Josef, was that the best opportunity, maybe the last opportunity to get into some of these stocks when oil dropped to $65 a barrel?
Yeah, Corey, we were basing our view on lower oil prices based on the demand side. Demand was weak in the United States. The EIA data that came out this week showed that total consumption of energy was down 0.3% from 2023, and finished motor gasoline was down 0.4%. So the biggest economy user of energy has got a negative number. China has got negative numbers, and the worst case for them is diesel, because the economy is sputtering around. So you've got a demand problem, and that was why we thought we would see lower prices. The big issue, though, was we had a war premium in there because of the concern at one point that Iran would get involved with the fight directly. And the price of crude, if you remember, went up to $87.67 in March, April. And then as things, cooled off and it wasn't looking like there was going to be a direct attack, the price of oil backed off to 72. Then there was the incident with Hezbollah, another situation with Hamas in terms of killing some of the main perpetrators of the attack of October 7th of last year. And then all of a sudden things cooled off and we started focusing on the demand side. And that's when the price of crude went down to 65.27. You had a lot of short selling by hedge funds, and that took out all of the war premium and took us down to the price we thought was attractive. Today, we're seeing in the last few days, we're seeing a price bump to $71, $72 a barrel, which is based on, the assumption that the Fed is doing the right thing with the 50 beeps over the 25 basis point cut, and that the economy is going to do okay with a soft landing. And my view is that I think we're going to see data. I don't think the Fed made the 50 basis point cut without knowing that there might be some bad data coming. We're already seeing consumer data very weak, retail spending being very weak, credit card delinquencies picking up, auto delinquencies picking up. The wealthy are doing well. Those who own equities and real estate are doing well. So the higher income people aren't really seeing any problem. It's the lower income people that are. And if that spreads you're seeing that the household survey for jobs is showing negative data, which differs from the monthly employment data that the Labor Department puts out. So you've got a dichotomy on two of the major reports. And if the data continues to weaken on the household survey, at some point that'll show up into the official numbers, and I think that will cool things off. And I think we're going to see a test of the lows, 66, 67 sometime in October, and then of course maybe bounce around because of tax loss selling in November, December. So there might be additional buying opportunities, and we've said we expect in our recent report that the price of crude backs off below 70 again into that 66, 67 range, and we might get another buy signal. We have three buy signals that we watch. One is the absolute price of oil, and that's what happened when we went down to $66, and we triggered the buy signal you mentioned that we did on September 10th, and we added 5 new names to our recommended list, and we reiterated 3 that were already there that were at extremely bargain values. So if people are buying, Canadian energy stocks, be they B cap, mid cap, small cap, if they're looking for dividend income, we have a lot of those names on that list, on the recommended list. And so as you've talked before, Ion Energy is where we provide the macro information, and in the paid subscription product is where we do the company specific information. And so I think we will see a test of the lows, and that will give us additional buying opportunities. I have a lot of stocks that are close to buy signals again. The other 2 buy signals I'm watching are, one is the absolute level of the TSX Energy Index, the S&P TSX Energy Index. That's trading right now in the 460 range. I think that's going to go down, in the 340 range. The fresh number, is 267. And I think that's going below 240. It was trading over 300 last year. So I think there's another 10, 15% decline. If we get below 240, that would trigger another buy signal. The other one is the S&P Energy Bullish Percentage Index that we've talked about many times. It was around, 70% in June, July when we had the robust prices for the sector. We've now come down to about 26%. And if I'm right that we see a sub 70 again, and if the markets in general are weak, that could come down below 10%, and that would be that would give us the third buy signal. So we're watching all of those. We were lucky and fortunate to be able to get the buy recommendations out last Tuesday. and I'm looking and I'm watching carefully for any further opportunities to add names. And we're just thinking that there might be backing filling between now and year end. The reason we're so bullish is we think that in the second half of 25, we will start seeing growth in the States, growth in China. I think they'll get through their problems. And the big thing is we're looking for the third world to bring on the commodities that we need: copper, lead, zinc, nickel, lithium, that are all going to be needed for the renewable energy transition. And they're not going to do it unless they can make good livings for their employees, and then the countries get good fiscal opportunities to make money themselves, which means that you're going to see higher prices for those commodities if we're going to get them. We had a nice run in copper to $5. It's back down into the low to mid fours, but that was at $5 was a record price, and I think we're going to see higher prices. Gold has been stampeding to record highs. Again, weaker U.S. dollar, all the concerns about the deficits around the world, and the concern about the ability to finance deficits. So I think we're going to see gold get more attractive and move even higher. So when a commodity cycle starts, you see a few run up early. So we saw cocoa and coffee. Then we saw the gold. We saw a nice bounce in energy. Now it's backed off. And again, I think we're going to see all of that get better, because I see $90 WTI on average in second half of 2025. And I see prices over $100 a barrel in 2026. And on the natural gas side, prices are very sloppy: 230, 240 for NYMEX, under $1 for AECO. But as we get into year end, we're going to be bringing on LNG Canada, which will be 2.1 BCF, which will help lower stocks in Canada and raise prices. The United States, there's one project coming on new at the end of this year, and there are two or three in 2025. So with all of that occurring, we're looking at $2.75, $3 for NYMEX next year, maybe $2.75 for AECO, Canadian dollars, and then much higher prices for both in 2026. So we're in the last phase of the weak period. And anytime you see weakness, you want to buy. You want to be a buyer on down days. Find the names you like. Pick a price that you think is attractive. Yields now are unbelievable. You've got some companies yielding. I'll just go through a few examples. You've got Birchcliff yielding 7.1%. Even some of the big utilities, Enbridge 6.7%. Freehold Royalties 8.3%. You've got Whitecap at 7.5%. You've got Pinecliff at 6.6%. You've got Surge at 8.5%. Alvo Petro 9.7%. Petrus 9.2%. So there's some very good yields out there for people who are wanting either big cap dividend from pipeline and infrastructure. The royalty trusts give you good yields, and a lot of the E&P companies are doing NCIBs or big dividends. Paramount's got a decent yield. It's one of the names that we really like. Paramount's yield is 6.8%. So there's some nice yields out there from companies that are, and that one's paying you a monthly dividend of 15 cents a month, $1.80. So, you look for these stocks on weakness, and the total returns can be exceptional. For the pipeline infrastructures, you're really looking for 10% capital gain. Take that 7-8%, and that's a fabulous total return when you compare that to what people can get in the bank. So for conservative investors, you can buy Enbridge, TC Energy, Pembina, Keyera. All of these companies provide very decent yields. And in the royalty trusts, you can get very good yields in Topaz and Freehold. And then in the oil and gas, I gave you some of the names and the numbers before. So there's some decent opportunities there as well. So I'm in the bull camp period. And as you know, I've been cautious in other months. And I'm looking for any of the periods of weakness between now and year end. Tax loss selling period, October could be nasty. A lot of people think the end of September could get nasty. I don't care what happens over the next 3 months. But if any more of those buy signal trigger between now and year end, it's time to just go from, let's say, 70, 80% invested in the sector up to where you think, or you and your investment advisor think is an appropriate 100% weighting for you. We are saying use any weakness from this period on to go to a fully invested position, depending upon what that is for you based on your circumstances.
All right, Joseph. So you've laid out a pretty solid bull case, even if we do see a corrective move back down into the 60s for oil and for nat gas as well. Now, you say you're looking ahead to 2025 and could see upwards of $90 WTI, but just to take the other side of it, let's look at the bearish thesis real quick. The Fed is cutting, to your point, because they obviously see some economic weakness in the forecast. And we've heard for 2 years that we're going to see a recession in the U.S. Obviously, China's not breaking any records, and Europe is already in a recession, many would argue. So what would keep the oil price levitated up to the 80s or 90s next year if everybody's in a recession and it's not a soft landing? What would happen if this economic contraction has some teeth to it and the oil price got stuck in the 60s? How stable are those dividends, and what would the company sector look like if oil doesn't jump as expected?
Well, if you're going to look at the world, and the world is going to have to start bringing on the copper, nickel, aluminum, that's where the growth is this year. If you look at the U.S., I said we have negative comparisons year over year, but we should see 750 to 850,000 BOE a day increase in 2024 based on third world showing the growth. India, South American countries, countries in the Middle East, European countries are consuming somewhat more. A lot of that is covered in, the EIA data or in the OPEC data. So you are seeing growth rates there. And so if we see the American economy, go through, let's say, a soft landing and come out of it, and if you have both parties supporting fracking and growing independent resources in the United States, then the oil industry is going to drill their tier one wells, and they're not going to drill them at low prices. What I find really amusing about the politicians is they think if they increase the production by loosening up the environmental standards, opening up federal lands, the price of oil is going to go down. No, the price of oil is going to go up, because unless the rates of return are attractive, the companies aren't going to spend the money, because you're going to need to build infrastructure on that land. You're going to have to drill the wells. You're going to have to do the seismic. And all of that requires a capital investment, and you want a return on that capital investment. So there's going to have to be higher prices, not lower. And this hope for sub $2 gas, I don't think happens unless there's a severe recession. And I think we're going to see this $3 to $4 gas stay in place. And if we see the economies, have that soft landing and recover in 2025, then of course that's going to cause some economic growth. And remember, just think about if we have a 2% global growth, that's going to require more than 2% increase in the demand for oil. Oil is right now, let's say 101, 102 annual demand. You pop on 2% on that, and that tells you that unless the spend increases in the non-OPEC world, which, they are in Guyana, they are in Brazil, but America, last week saw a decline of 100,000 BOEs a day from 13.3 to 13.2, simply because the industry is not getting the economics they need. And that, under $70, the industry slows down because they're not making the rate of return, even on their tier one wells, and they're definitely not drilling their tier two wells. Tier one wells, they want a 1 year break even. If a tier two well based on sub 70 could take 2 years for a payout, they don't want a 2 year payout. They want everything under a 1 year payout. Because remember, the depletion in year one is 50 to 70%, and then 20, 30 after that, and then it's smaller. So if you get a well that comes on at 1,000 BOEs a day, it'll be 200 to 300 at the end of the year. Then it goes down to 150. So of course you got to keep on drill, baby, drill. And a lot of that is to offset declines, but you want to be drilling your high quality wells, but at under $70, you have a lower number of those. You get to 85, 90, you have a way more. You get to 95 or 100, you can drill up those tier two wells and get under a 1 year payback. So I think that the price level for energy has to go higher if you're going to incentivize the industry. Because right now the industry is focused on the pressure from shareholders who are saying, hey, we want dividend yields, we want NCIBs, we don't want you spending all your money, we want to be paid. And that pressure is on both sides of the border. and many companies talking about the pressure by institutions, especially for NCIBs, and retail investors are saying, pay me a dividend.
Okay, Joseph, I want a little bit more clarity then on what you consider some of the fundamental factors of the stocks that separate themselves from the rest of the pack. Because, look, let's say the oil price stays relatively stable or even continues to appreciate. Well, then it seems like a lot of these energy stocks are fundamentally strong across the board. So, what are the factors? Simplify that for me that separate the best from the rest.
Okay, what you want to do is look at companies that have a growing production profile, significant insider ownership, and low debt. So, for example, Trican has cash and no debt. Paramount Resources has investments and offsetting the debt. So you got a kind of a no debt situation there. And anytime you can find a company with low debt and growing production and a payback, that to me is what you're looking for. I was on a call yesterday with Coetino, and they're producing sub 30,000, but they have a 2026 goal of getting to 40,000 BOEs a day. Their balance sheet is in good shape, so they can continue to grow their business. And you've got a company with a market cap of 621 million, only 207 million of debt, and they did 26,292 in Q2, and that number will be 29,000 in Q3, and they're heading to over 30,000 on an exit level this year, and then next year do more drilling and get to 40,000 in 2026. So you like companies like that have growth like that. You've got New Vista, you've got Birchcliff, you've got Tourmaline, you've got Paramount. There's just so many names. And the question is, do you want companies that are larger cap or smaller? Smaller cap companies can grow faster. Do you want the cleanest balance sheet? Do you want extremely high or high insider ownership? We cover that in our research so that the subscribers can go and get all that information. This month, we're going to, in the issue that's coming out next week, we do an insider trading report so you can see which companies that we cover have seen insider buying, and quite a few have because of the lower prices that we saw in the last week or two. There have been some that have been sellers, so that's of note, because if they're selling insiders, and if it's quite a few insiders, that's a warning signal that maybe operationally things are challenged and they want to take some money off the table. If there's a one-off, it could be they want to pay down a mortgage or whatever. But when you see multiple insider sells, that to me is something to be concerned about.
Well, Joseph, contrast for us the environment of pricing we have now, let's say in the high 60s to 70s, versus if it gets up in the 80s and 90s, how that affects M&A, because there's two sides to that equation, the company selling or the company acquiring, and sometimes high prices give the juniors or the smaller companies, the mid-tiers, maybe more of an incentive to ask for too much, and maybe the companies are hesitant, but then lower prices, sometimes the larger companies can use that arbitrage they have in valuation to pick off the little guys. How do you see the M&A cycle playing out in different price scenarios?
Well, when you get companies with debt and we have one of those weaker price scenarios, companies get taken under. So we saw Pipestone being taken under by Strathcona. We saw Storm being taken out by CNQ a few years ago. We just saw a deal for Crew, which is being taken over by Tourmaline in early October, and they paid a very high price because they had 30,000 BOEs of production, but they had drilling inventory to take that to 60,000 BOEs a day. So Tourmaline was willing to pay for that. As you may know, we've been big fans of Crew for a long time, so we will be getting our shares of Tourmaline, which will be with a low cost base because we had a low cost base on Crew. So we're going to be pretty happy to own Tourmaline going forward. So that's a positive. When you get to the frothy markets, like we did in 2008, or going back even to the late 70s cycle, 1979, 80, 81, you'll have a lot of takeovers, but you'll have foreigners coming in because they want security supply. And, if Canada's political system isn't ugly, they'll come in because they want that security of supply. I'll give you, one clean example of that. Mike Rose sold Berkeley to an American firm and sold Duvernay to an international firm. So you're going to find those buyers come back when they want to capture the Montney and the Duvernay for LNG on the West Coast. And they're going to want to control significant TCFs of gas, liquids rich mostly of that, so that they can meet their growth targets for their LNG business. And I think that's going to be an attractive. One thing to point out that LNG Canada, many of the members there do not have enough gas to meet their commitments. So when the first LNG shipments come, they may be forced to either contract with operators to buy gas from them, as we've seen ARC and Tourmaline do it with the U.S. side, or we could see takeovers where there's acquisitions of companies with a significant resource potential. And we cover a lot of companies in the Montney Duvernay area because we think consolidation is going to happen. Once we start seeing more than just LNG Canada on, LNG Canada announces the second phase. We get Rockies LNG going forward. We get a number of the other projects going forward. We could have 6 to 8 BCF of new demand coming on before the end of this decade. And put that in context, we produce 16, 17 BCF that right now goes south and east. If we automatically have 6, 7 BCF going west, we're going to have to drill out a lot of new wells, and you're not going to do it if the economics aren't attractive.
All right, Joseph, thanks for that broad update in terms of the energy space, some of the opportunities, and I think even more importantly, what companies investors should be focused on. Let's talk about your upcoming conference. As I said, October 19th, catch the Energy Conference in Calgary. As I said, I've been a few years in a row now. I really like the opportunity to sit in longer presentations by the companies and also visit with management at their booths. You've given us the opportunity to give away 2 free tickets. So please, people, email me if you want those 2 free tickets, and we will run a draw for those. But Joseph, give us a little overview, update on what to expect at this year's Catch the Energy Conference.
Well, we have a mixture of the energy industry of today, which is, the E&P companies, service companies, and then there's the energy industry of tomorrow that the TMX sponsors. So they'll have one room with critical minerals and companies in clean tech there. We right now have 41 of our spots taken. We have 4 more to fill between now and month end. And so 45 presentations going on. The conference opens up. Last year, we had the premier open it. This year, we have Brian Jean, the energy minister. Then we have these 35-minute breakout sessions, 25-minute presentations by companies, and moderated Q&A by professionals for 10 minutes. And at the end of the day, we have an LNG panel, which will have on it Chris Carlson, the CEO of Birchcliff, Charlotte Raggett, who's the president of Rockies LNG, and Brian Jean, our energy minister, will be interviewed by Jody Anhorn, who's the president of GLJ, the big reservoir engineering firm. So it's going to be a full day, food all day, and all the way from a hot breakfast when you come. We then have the big presentation in the Bella Hall, and then we go over to the other section of the building, which is where we have the conference for the rest of the day. So it's a full day, and I'll be doing my presentation to help guide individuals coming who don't exactly know where they want to go. So I'll break down the sections of who's here, and then they can decide that they want large cap, small cap, dividend, whatever, energy service, and all of that will be covered so that people can make decisions on how to spend their day. I'll be at the booth too, our booth, so people want to come over and say hello and chat. Very happy to do it during those 2 big booth sections when we'll be spending time at our booth.
All right, Joseph, great chatting with you on this weekend show. Again, Josef Schachter, founder and editor of the Schachter Energy Report and the Ion Energy Report. Check out the links that I post within the show notes to find out more about his conference, and email me directly, fleck@kereport.com, with the subject line being conference raffle tickets. I will add all those, and we will provide a raffle in the upcoming weeks to give one of you 2 free tickets to the conference. Everyone, thanks for tuning in to this weekend show. Again, please go back to our website, podcast, and YouTube channel to listen to all of our daily editorials covering another wild week in the markets, driven a lot by that Fed rate cut. Everyone, thanks for tuning in to this weekend show.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.